Closed-end funds for years have been a source of income for many investors by virtue of the fact that the way they're managed, of course. Many of them have distribution policies which generate yield, and they do it in conjunction with either capital appreciation recognition, income, sometimes return of capital. I think it's particularly timely right now in this world where you're really not getting any income from many fixed income products. You get to get diversification with respect to closed-end funds. You can invest in equities, you can invest in convertibles, you can invest in high yield, many different sources. That in conjunction with the leverage, and I think leverage works very well now given the lower interest rates, and that the reinvestment rate is typically higher in a bullish market than what you're paying out in leverage. So all of that is a benefit to the closed-end investor because then that's a source of return through the product, through the vehicle. So I would say they're great sources given the low leverage and clearly the fact that you're buying a diversified product that gives you different sleeves that you can invest in and participate in different markets to get that income. Well, convertible bonds are a great product for the closed-end fund space in that they are really a sort of a risk-managed way to play the equity markets, given that you've got the coupon component, which serves as a buffer against moves in the equity market. So you get the participation from the equity portion of the bond. So in essence, what you're doing is you're getting the equity upside, but you get the coupon from the convertible as well. So it's a great vehicle to have, particularly right now when many people are afraid that the equity markets may be fairly high, fairly valued. So you're still participating in those, but you're getting the income which sort of cushions the blow if you do have some adjustments or volatility in the general equity market. But again, it lends itself to the closed-end fund product, and then again, you're getting that income component which the client's looking for and you can use to source your distribution payments. Well, I think you have to look at the total return of what the fund has provided. I think you have to look at the manager, how well they've been able to manage the particular fund. But I think you also have to look at what the fund invests in. Do you think that that's an opportunity now or not? So all the underlying principles of any type of investment never go away. That said, any type of investment, you should look at the valuation of what the investment that you're buying and where that is relative to where it's been or relative to where you think it may be going. So I don't think it's necessarily bad to buy a stock, a closed-end fund position that may be trading at a premium if you think the returns may be better there than maybe funds that are trading at discounts. That said, in the closed-end fund space or anywhere, when you see a value and a discount is a value relative to the NAV, that's compelling in and of itself. I will make the point that closed-end funds, because they tend to be retail-held, centric, and tend to be under-researched relative to just the number of analysts that are out there, these things can really go on sale sometimes when there's a disparity in the markets that can drive the price down relative to what the NAV has done. So I think all things being equal, there's some real opportunities to take advantage of the closed-end funds when they do what I will say go on sale. But by and large, I think clearly you can look for value, but I think you have to look at, there's a number of other aspects in the closed-end fund space and the macroeconomic space that you have to consider before you buy any investment.